Imagine a landscape without the familiar blue and yellow logo. Walmart gone from towns across America. Walmart is an American icon, built on low prices and vast logistics. But tariffs have forced even giants like Walmart to rethink strategies. As the nation's largest private employer and a price setter for millions, any shift in Walmart's U.S. strategy is about more than business. It's about the American economy. The question isn't if Walmart will leave, but how it will adapt, and what that means for the country. To understand Walmart's dilemma, we need to examine the tariff policies themselves. The Trump administration's America First strategy was rooted in economic nationalism, arguing that free trade had hurt U.S. industry and jobs. The solution: tariffs, taxes on imported goods, especially from China, to make American products more competitive. These tariffs were sweeping, targeting tens of thousands of products, including electronics, clothing, and toys, the very items that fill Walmart's shelves. Tariffs often added 10%, 15%, or even 25% to the cost of imports, a radical break from decades of trade liberalization. The idea was to revitalize U.S. manufacturing, betting that short-term pain would yield long-term gain. But for businesses, this created volatility and uncertainty. Costs could change overnight, making long-term planning nearly impossible. For Walmart, which thrives on predictability and thin margins, this was an existential threat. The tariffs weren't precise. They were economic shock therapy. Companies could no longer rely on stable sourcing agreements. The new trade landscape challenged the very foundation of Walmart's business model. The question became, how does a global retailer survive in a world where its core strategy is suddenly penalized? The answer would reshape not just Walmart, but the entire retail sector. Walmart's success is built on relentless global sourcing, finding the lowest cost manufacturers worldwide. China has long been the centerpiece, offering vast capacity and low costs. Many Walmart products, and even national brands, are made in China. Tariffs directly targeted this supply chain, imposing a tax on Walmart's core sourcing strategy. Walmart's model depends on massive economies of scale and razor-thin margins. A 25% tariff can't simply be absorbed, it upends the entire cost structure. The company faces a tough choice: absorb the cost and hurt profits, or pass it to consumers and risk losing its price-sensitive base. Tariffs didn't just raise costs, they attacked the logic of Walmart's business. The America First doctrine favored shorter, more expensive domestic supply chains. Walmart was forced to urgently seek alternatives to its China-centric model. Reconfiguring a supply chain built over decades is no small feat. The challenge: adapt quickly or risk losing the competitive edge that made Walmart an American giant. The stakes for both the company and its customers couldn't be higher. The tariff's immediate impact was clear: higher costs for imported goods. Despite claims that China would pay, the reality is U.S. importers like Walmart footed the bill. These costs rippled through the supply chain, leaving Walmart with limited options. Absorbing the cost would devastate already thin profit margins. Pressuring suppliers to lower prices has limits. Suppliers can't operate at a loss. Most often, the cost is passed to consumers as higher prices. Studies confirmed U.S. importers and shoppers bore the brunt of tariffs. For Walmart's core customers, low and middle-income families, even small price hikes matter. The promise of "save money, live better" is harder to keep when costs are inflated by policy. Tariffs also created operational chaos. Uncertainty about which products would be targeted next made planning nearly impossible. Retailers scrambled to import goods before new tariffs hit, driving up warehousing and inventory costs. Supply chain managers rushed to find new suppliers in countries like Vietnam or Mexico, a slow, risky process. The result: not just higher prices, but inefficiency and disruption in American retail. The finely tuned logistics that kept shelves stocked and prices low were thrown into disarray. For Walmart, the challenge was not just financial but existential. The financial impact of tariffs on Walmart is measurable and significant. Walmart's SEC filings and executive statements made it clear higher costs would be passed to consumers. Estimates suggest Walmart's imports from China total tens of billions annually. Even a 15% tariff on a fraction of that means billions in extra costs each year. In 2019, Walmart's CFO warned that tariffs would force price hikes. There was no way to absorb the full blow. Economic studies confirmed goods targeted by tariffs saw higher inflation, with staples like washing machines rising sharply. The tariffs acted as a regressive tax, hitting lower-income households hardest, Walmart's core customers. This financial strain forced Walmart to rethink its U.S. strategy. If the market becomes less profitable due to policy, companies shift investment elsewhere. The incentive to expand in the U.S. fades if the business model is undermined. Tariffs became a catalyst for strategic change. The idea of Walmart leaving America is a dramatic oversimplification. Walmart is deeply American. Its U.S. market is by far its largest and most important. Abandoning it would be corporate suicide. But leaving can mean more than closing stores. A more realistic scenario is a gradual, strategic pivot slowing domestic investment, shifting capital to faster-growing, more stable international markets. It's not abandonment, but rational adaptation to a riskier U.S. environment. Corporate functions could move abroad. Global sourcing headquarters, for example, might relocate to Singapore or Mexico. This would mean fewer high-paying U.S. jobs and less tax revenue, even if stores remain open. The real risk is a slow retreat, hollowing out corporate functions, diverting investment, and shifting growth strategy away from America. Tariffs make the U.S. market more costly and unpredictable, incentivizing this pivot. The question isn't whether Walmart will close its doors, but whether the U.S. will remain its central focus. That's the real concern for the American economy. The consequences are subtle, but profound. With China less reliable and more expensive, Walmart and others have explored alternatives. Reshoring, bringing manufacturing back to the U.S., was the policy goal, but it's a massive challenge. The U.S. lacks the infrastructure and workforce to produce Walmart's vast inventory at low prices. Efforts to source more American-made goods are real, but small in scale. Nearshoring, moving production to nearby countries like Mexico, is more feasible. It shortens supply chains, cuts transport costs, and leverages trade agreements like USMCA. Imports from Mexico and Southeast Asia have surged as China's share drops. For Walmart, this means building new supplier relationships and reworking logistics. It's complex and costly, but necessary for resilience in a world where reliance on China is risky. The supply chain of the future will be more diverse and more expensive to build. In the end, the real impact of tariffs lands at the cash register. The trade war functions as a tax on American consumers, especially those shopping at Walmart. For low-income families, even small price increases on essentials are a burden. The policy aimed to help American workers, but the immediate effect was higher living costs for those same workers. Any long-term gains from reshoring remain speculative. The costs to consumers are immediate and real. Studies show the tariffs' costs far outweigh any benefits from new jobs in protected industries. Walmart's story is a microcosm of the national debate: protectionism versus consumer welfare. Tariffs are a blunt tool, imposing widespread costs while offering uncertain benefits. For millions relying on Walmart, the trade war meant higher daily expenses and a tougher path to live better. The lesson: economic nationalism has real, often unintended consequences for everyday Americans. The idea of Walmart leaving America is a dramatic simplification of a deeper economic shift. Tariffs didn't close Walmart stores, but they attacked its low-cost global sourcing model. The result: higher costs for consumers, especially those with the least to spare. Walmart and other retailers are adapting, pivoting away from China and diversifying supply chains. This shift weakens the incentive for future U.S. investment. The episode is a case study in the real-world impact of protectionist policy. Tariffs didn't force China to pay, American consumers did. The promised manufacturing renaissance hasn't materialized. What has is inflation and operational chaos. The big question: if economic nationalism continues, what will it mean for America's global competitiveness and standard of living? The answer will shape the future of both Walmart and the nation.